Repsol SA, REP, presents a compelling investment case characterized by a calculated strategic pivot, robust integrated business resilience, and an exceptionally generous capital return commitment. The company's integrated model continues to generate high operational cash flows (OCF), enabling it to self-fund an energy transition that prioritizes profitability over immediate regulatory alignment. The investment thesis centers on a significant valuation disconnect. While analyst consensus price targets hover near the current trading level of approximately €15.75, discounted cash flow (DCF) models suggest an implied fair value of €25.63. This wide gap is expected to close due to management's aggressive use of share buybacks and robust operational performance that secures dividend payments. The investment is justified by the immediate catalyst provided by the $10 billion Shareholder Remuneration Program 2024-2027 and the underlying strength demonstrated by the Q3 2025 results. Macro environment, commodity price outlook, and geopolitical headwinds. Repsol operates within a global energy market defined by high volatility, where crude oil prices are susceptible to complex exogenous factors including geopolitical instability, the influence of OPEC, supply/demand fluctuations, and technological shifts. The global context remains marked by geopolitical instability, as noted in the Q3 2025 results commentary. Repsol's strategy is designed to mitigate these commodity risks through its integrated business model, spanning upstream, industrial, and commercial segments, aiming to maintain a low to medium risk profile across the entire value chain. This diversification provides an operational hedge. For instance, despite the unstable global context, Q3 2025 saw all of Repsol's businesses improve their results. This result confirms that the industrial, refining, and commercial segments are currently stabilizing overall corporate cash flow, benefiting specifically from robust refining margins and the expansion of multi-energy offerings. European regulatory landscape and the net zero imperative. Repsol maintains an explicit, unwavering commitment to achieving carbon neutrality by 2050. However, the 2024-2027 strategic update details a capital allocation approach that poses a critical conflict with emerging regulatory requirements. The plan allocates between 55% and 65% of net capex, equivalent to $2.5 billion per year on average, to fossil fuel projects. Repsol continues to invest in new oil and gas projects. This investment split stands in direct opposition to the International Energy Agency's (IEA) net zero emissions scenario, which suggests that, to align, a minimum of 50% of capex must be channeled into clean energy by 2030. Furthermore, only 32% of Repsol's 2023 capex was aligned with the EU taxonomy, with 61% deemed non-eligible. This strategic choice implies that Repsol is consciously prioritizing near-term financial profitability and maximizing cash harvesting from its core assets, accepting the regulatory risk that high-carbon assets may face accelerated depreciation or impairment if regulatory momentum mandates faster transition than currently planned post-2027. Repsol appears to assume that regulatory enforcement will not accelerate swiftly enough to prohibit the profitable deployment of the current fossil fuel capital allocation before 2030. Peer group structure and benchmarking methodology. Repsol's relative valuation supports the benefits derived from its integrated model. The company's latest 12 months LTM enterprise value to EV/EBITDA ratio is 5.0x. This places Repsol favorably relative to other European integrated energy companies trading slightly below Shell plc, 5.2x, and near Total Energies SA, 3.6 to 4.5x. The multiple is significantly higher than that of less diversified peers like OMV AG, 2.5x, or Equinor ASA, 1.7x. This trading pattern suggests the market applies a modest valuation advantage for the company's diversification and its proactive approach to converting its high-margin industrial assets into future low-carbon fuel production facilities, securing more stable, consumer-facing revenue streams that decouple earnings growth from volatile upstream commodity prices. However, a discrepancy exists in the earnings multiple. Repsol's price-to-earnings ratio at the end of 2023 was 5.5x, which is substantially lower than Total Energy's 2024 PE ratio of 8.09x. This low PE multiple indicates residual market caution regarding the durability and quality of Repsol's long-term earnings, primarily attributable to the substantial capital expenditures required for its transition strategy and the ongoing regulatory risk. Q3 2025 Performance Review and Consensus Variance Analysis. Repsol reported solid operational and financial results for the third quarter of 2025, supported by robust refining margins and strong commercial activity. Adjusted income, the primary operational measure used by management, totaled €820 million for the quarter, reflecting a substantial 47% increase compared to Q3 2024. Adjusted income reached €2.173 billion for the first 9 months of the year. Net income also showed significant growth, totaling €574 million for the quarter. While revenue met analyst expectations at €13.11 billion, the company reported an earnings per share (EPS) of 0.5835, missing the consensus forecast of 0.6304 by 7.44%. Following the announcement, the stock experienced only a minor decline of 0.72%, closing at €15.75. The market's muted reaction to the EPS miss suggests that sophisticated investors are focusing on the underlying financial strength, particularly the 47% growth in adjusted income and high operational cash generation. These operational metrics are considered superior indicators of the company's capacity to fulfill its strategic CapEx and shareholder remuneration commitments, prioritizing them over non-core accounting variability, reflected in the EPS figure. Segmental contribution analysis: upstream, industrial, commercial, and renewables. The broad-based improvement across all business units in Q3 2025 highlights the benefit of Repsol's integrated structure. The upstream segment, which was bolstered by the merger completion with Neo Energy, reported a 10.5% year-over-year increase in adjusted income, reaching €317 million for the quarter. This provides essential exposure to commodity pricing. The stabilization of earnings comes significantly from the downstream segments. The industrial and commercial businesses have demonstrated resilience, benefiting from the robust refining margins noted by the CEO. The customer business continues its upward trend, primarily driven by its multi-energy offering, which provides tailored solutions for households and mobility. The integration of multi-energy solutions across 56% of Repsol's service stations in Spain is essential for long-term value creation. This capability allows the company to transition its industrial output into higher-margin retail sales channels for low-carbon fuels and power, securing more stable consumer-facing revenue streams that decouple earnings growth from volatile upstream commodity prices. Cash flow generation and capital discipline. Cash flow from operations, OCF, serves as the definitive financial metric for the investment thesis. OCF reached €1.5 billion in Q3 2025, culminating in €4.3 billion year-to-date, representing a 15% increase compared to the previous year. This substantial and growing OCF is the financial bedrock that supports the entire strategic plan. It fully funds the company's ambitious €16 billion to €19 billion net capex plan, while simultaneously guaranteeing the massive $10 billion shareholder remuneration commitment, which is specifically structured to distribute 25 to 35% of OCF. The high operational cash generation provides significant financial optionality, allowing management to deploy surplus cash for accelerated low-carbon capacity build-out or additional share repurchases, depending on maximizing returns. Balance sheet strength and financial flexibility. Net debt trajectory and liquidity assessment. Repsol reported net debt of €6.9 billion in Q3 2025, reflecting a €1.2 billion increase since June of the same year. This increase is primarily attributed to strategic capital deployment, notably the completion of the merger with Neo Energy. This rise in leverage is strategically justifiable because the capital was directed toward accretive M&A activity that immediately strengthens the upstream portfolio, thereby supporting future cash flows and maintaining the integrity of the balance sheet within the parameters set by the investment grading ratings. Credit rating confirmation and debt covenant health. Repsol maintains robust, stable investment-grade credit ratings, BBB+, stable from Standard & Poor's and Fitch, and Baa1, stable from Moody's. Maintaining these ratings is crucial as the energy transition is a capital-intensive endeavor requiring billions of euros in new investment. The strong credit profile minimizes funding costs for the $16 billion to $19 billion CapEx program, ensuring the company can execute its strategic growth plans efficiently without placing undue pressure on its balance sheet. This protects the company's ability to deliver the promised shareholder returns. Capital Allocation Framework, 2024 to 2027, Balancing Growth and Returns. The 2024 to 2027 Capital Allocation Framework is a defining feature of the investment case, allocating up to 10 billion euros to shareholders. This program includes $4.6 billion in cash distributions and up to $5.4 billion allocated for share buybacks. The cash dividend is expected to surpass €1 per share in 2026. The focus on share buybacks is highly strategic, leveraging capital management to generate investor value. Having already reduced outstanding shares significantly from 1.527 billion to 1.217 billion between 2021 and 2023, the continued buybacks act as a mechanism to mathematically enhance earnings per share, EPS, and forcefully reduce the PE multiple. This proactive capital management is designed to close the wide gap between the current market valuation and the implied DCF intrinsic value, thereby demonstrating management's confidence that the stock is undervalued. Strategic Assessment: The Profitable Energy Transition Model 2024 to 2027. The Dual Investment Strategy: Hydrocarbon Sustenance versus Low Carbon Acceleration. Repsol's Strategic Update 2024 to 2027 prioritizes a profitable energy transition model, balancing two distinct capital allocation streams. The allocation of 55% to 65% of net capex, approximately $2.5 billion per year, to fossil fuels serves to maintain the high-margin cash-generative core business. Simultaneously, over 35% of the net capex, $5.6 billion to $6.6 billion total, is committed to low-carbon projects. This proportional investment plan provides assurance that the substantial transition capital is secured entirely by high, predictable cash flows from the existing hydrocarbon base, insulating the transition investments from external market volatility and minimizing funding risk. Deep dive into CapEx allocation, fossil fuels versus low-carbon initiatives. Within the low-carbon expenditure, the allocation is focused on two key areas. First, 15 to 25% of the total net capex is directed toward renewable electricity production. Second, and highly notable, 10 to 20% is allocated specifically to renewable fuel production. This emphasis on renewable fuels demonstrates a differentiated strategic priority, leveraging the company's existing complex industrial processing expertise, refining, to create higher-value decarbonized products, synthetic fuels, advanced biofuels. This strategy aims to achieve superior returns on transition capital compared to competing solely in the increasingly commoditized utility-scale solar and wind power markets. Low-carbon generation, LCG, build-out and execution risk. Repsol's low-carbon generation, LCG targets are ambitious. The company aims to reach between 9 and 10 gigawatts of installed capacity by 2027, building upon its existing operational capacity of over 4,700 megawatts. A significant portion of this growth is targeted for North America, where the goal is to exceed 3 gigawatts by 2027, including 1,400 megawatts currently under construction. This reliance on geographic diversification is a crucial element in de-risking execution. By expanding aggressively in markets like North America, alongside projects in Spain, Chile, and Italy, Repsol mitigates regulatory risk tied to any single national market and secures a more reliable flow of future low-carbon revenues, validating the long-term cash flows projected in the DCF valuation. Geopolitical and operational risk exposure. Repsol's integrated risk management system is proactively used to define strategy and enhance operational flexibility during critical situations. However, the global footprint exposes the company to specific geostrategic risks. These include the potential for asset loss due to arbitrary government actions, regulatory risks, and exposure to acts of direct violence in operating regions, such as Libya, where intermittent production stoppages have occurred. Ongoing management of these risks is essential to maintain the company's stated low to medium risk profile. Commodity price and refining margin volatility. Financial results remain highly sensitive to fluctuations in the benchmark prices of hydrocarbons and refining margins. The CEO's acknowledgement of robust refining margins as a key factor in the strong Q3 2025 performance highlights this dependency. A scenario involving a prolonged structural decline in global refining margins would directly impact the stabilizing cash flow of the industrial segment, potentially limiting the capital available for both the transition capex and the substantial shareholder remuneration. Transition risk and regulatory alignment. The primary structural risk is the gap between the 55 to 65% fossil fuel capex allocation and the IEA's recommendation for cleaner energy investment. This deliberate investment choice, while maximizing near-term cash flow, ensures that Repsol carries a valuation discount relative to peers perceived to be more advanced in decarbonization. This lack of full EU taxonomy alignment poses a material long-term threat related to potential future regulatory penalties, high carbon costs, and the risk of stranded assets if the political and regulatory environment accelerates mandatory phase-outs post-2027. Corporate governance and executive compensation alignment. Repsol has robustly aligned executive incentives with its strategic transformation. 40% of the long-term variable compensation for key executives, 2023 to 2026, is explicitly tied to energy transition metrics. These metrics include 30% for reducing carbon intensity and 10% for increasing low-carbon capacity production. This quantitative linkage ensures that management's financial interests are structurally integrated with the delivery of the strategic transition goals, reinforcing confidence in the plan's execution. Valuation and peer comparison. Relative valuation. Multiples benchmarking. Repsol's current LTM EV/EBITDA of 5.0 suggests that the market is willing to pay a premium above its historical median, 3.4x, recognizing the benefits of diversification and strong Q3 operational performance. However, the lower PE ratio compared to major European peers, 5.5x for Repsol in 2023 versus 8.09x for TotalEnergies in 2024, implies residual market caution regarding the longevity and sustainability of earnings, likely due to the size of the required transition investment. Discounted cash flow model, long-term value drivers. The investment analysis reveals a pronounced disconnect in valuation. The current analyst consensus price target of €15.76 is virtually flat against the stock price, reflecting cautious near-term sentiment. Conversely, sophisticated DCF models indicate an intrinsic fair value of €25.63. The 25.63 DCF valuation fully integrates the successful execution of the 9 to 10 gigawatt low-carbon capacity build-out, assuming these assets generate stable contracted cash flows. The current market skepticism represents an opportunity, provided management continues to demonstrate execution success in its transition targets and maintains its robust cash flow generation. The primary mechanism for forcing the valuation closer to its intrinsic level is the aggressive share buyback plan, which mathematically increases EPS and compresses the PE multiple.